Retail sales surprised on the downside, and my colleague David English has sent a message out saying that retail sales haven't grown in single digits since 2003. Should we read too much into that?
I don't think we should read too much into that, because remember that these are nominal growth numbers. Real growth was probably as strong as towards the end of last year, because inflation declined in January and February, and that's the reason why the numbers were weaker. So I wouldn't be too concerned.
Yeah, because inflation was a complete opposite to what was expected. I mean, we've got really, benign inflation there, almost disinflation, didn't we, on the CPI at least?
Exactly. So the data, remember, is an average for January and February. Inflation for January and February was relatively low, so it's not surprising that in nominal terms, retail sales didn't do that well. But growth was still quite strong.
Let me bring up this Bloomberg chart now. This is showing you retail sales, and it's looking at also production, because the IP number was stronger today than actually had been expected. So what does this tell us, this 6725 chart here? What does it tell us about that move towards a rebalancing of the Chinese economy?
On this front, it is not good news, because clearly we hope that consumption will accelerate and investments will decelerate. This is not really happening. Retail sales decelerated, investments accelerated. Having said that, remember that what we really want to see is private consumption picking up pace, and the data doesn't break down consumption into private and government funded. So it is still possible that private consumption is doing well. And when you look at car sales in the first 2 months of the year, they were actually quite decent. Growth was almost 10%. So private consumption is alive and fairly well.
Yeah, Darius, it's interesting. We're seeing these lines coming through from the National Bureau of Statistics in their press conference at the moment, saying that if you exclude auto sales, retail sales actually grew at the same pace in Jan-Feb 2016. So that's one explanation for it, I suppose. But I want to get your ideas on what the reform agenda looks like this year, because we know there's a big party powwow towards the end of the year, and most analysts are saying they're expected to tread pretty lightly ahead of that massive political reshuffle as CIB really seem to be consolidating power. Do you hold sort of high expectations for the reform agenda? It often feels like it's sort of, one step forward, two steps back, in particular when it comes to cutting over capacity, dealing with the leverage issues in the system.
When it comes to overcapacity, they did make progress on the coal, steel, and real estate inventory fronts last year. They plan to continue to make incremental progress this year. So I would say that here, we do have continued good news. I expect them to deliver. It will be challenging because there will be layoffs, but they are planning to take care of the people who will be laid off. So despite the fact that the Communist Party Congress is happening in Q4, there is some courage here on the reform front. When it comes to capital controls, unfortunately, we do have this 2 steps forwards, 1 step back situation, with capital controls being tightened in recent months in order to stabilize the renminbi. And as long as renminbi is under significant pressure from capital outflows, those measures will be in place. I think the market is prepared for that.
What about credit growth? Because we heard throughout the National People's Congress, there seems to be a renewed focus or realization that this is starting to perhaps get out of control, that you have these, shadow financing, of course, and also non-performing loans, and the wealth management product seems to be a real bugbear for them at the moment. Is it a little bit of too little, too late that they're dealing with it now?
I don't think it's too late, because the level of leverage in China, while high by standards of other emerging markets, is not too high compared to the major developed markets around the world. The problem for China is that they need to increase leverage if they want to meet their growth targets, to which they have made a political commitment until 2020. As a result of that, even this year, despite talking about deleveraging, they're planning a growth of 12% in aggregate financing. 12% is double the level that the GDP is supposed to grow, which tells you how much new money and new leverage is necessary for achievement of the growth targets. And China, unfortunately, will see a continued increase in leverage until 2020, as long as they stick to the ambitious expansion plans.